He's like, you're not in the center of the camera. Move over. There we go. So we are putting everything on flash sale. Since today is zero commission day, we're going to do 10% off. I save 8%, you save 10. It works for everybody. It's a win-win. How many of you ran shows? Did anybody run shows today for zero commission day? I was trying not to do full-on sell shows today. Did you? Did it go good for you, Curated? K-Pot, you did too. So how did they go? Did you feel that your customers were less? Or did it work out good? Wow, your best show. Well, that's great, especially with no commission. You can't ask for more than that. That's wonderful. Congratulations. We have found in the past, typically there's a kind of a whole group of us that we don't really do shows on these days, because we find that it's so flooded that the market's just so dispersed that we don't get a lot of sales. So I'm really happy to hear that you got sales. Sold 10 items, very good. So, all right, that's great. I was in a lot of shows today. I was in and out of shows. We are, tomorrow morning, we are doing a show. Not really? No, okay. Tomorrow we are doing Timeless and Elegant. So that is like Lennox and crystal and glass and just those beautiful, classy pieces. That's what's coming up tomorrow at 8 a.m. That show is already scheduled, and there's a video on there so you can get a good idea. Also, everything behind me, that's what's going to be in the show tomorrow. That's how it was for you when you were newer. Oh, okay. Yeah. I don't know. For me, they just don't do good. But I don't mind doing flash sales. That's fine. Just do it a little bit. I'll stick my toe in the water a little bit on these days. Now, if I have a regularly scheduled show, I'll just keep on with my normal schedule. I just don't try to do extra on those days. This morning, I want to follow up on a question that somebody asked me this morning because I'm testing this out. Somebody said in the show this morning, they're like, hey, I see that when I'm scrolling my For You page, there's videos from sellers. I've noticed them too. They're like, how do you do that? I wasn't quite sure, so I went and checked it out. Come to find out, what you do for your video is just add a video to a listing. So you have any, listing that you have in your bin, you can create a video and upload one 30-second video to that listing. Those are the videos that should pull over into that For You page when you see them. Has anybody here seen the videos? Because I'm finding something very interesting. When I'm on my main Zoe's Treasures account and I go to my For You page and I'm scrolling, I see the videos. When I go to my other account, like my burner account, there's no videos. And I follow people on that account, so there should be. I'm not seeing videos. So I tested it out. I did 2 videos. Let me know, hey, if you guys ever come across and you see my video, I did it for the 2 courses that I have. Let me know. I'm curious if these ever show up for somebody. So if you just happen to come by it when you're scrolling one day, shoot me a quick DM. No, not on the thumbnail, on the actual item you are selling. So go to your inventory tab, find an item you're selling, and you can't do it on the computer. It only worked on the phone. So open up an item that you have for sale from like your bin or your marketplace, and then where you would put a picture, you can click and it allows you to upload a 30-second video. So give it a try. She said it was in beta. Okay, well, it allowed me to put the video on. So the video's there. I just don't know if it's going to show up for other people on their For You page. Now, if you were to click into like this listing right here, there should be a video on there. So if you're able to click it into there, there's a picture and a video. So we'll see. So speaking of the listings, we have 10 or so all on flash sale. The 2 that be a great deal today are the Reselling Business Workshop. So this is our Monday night workshop where we are going how to set up your reselling business from the very beginning all the way through your first couple of shows. And what the workshops entail is you get the recorded Whatnot video. I know you can spend $3 on a sticker and you can watch it for 60 days. The course actually gives you access to all of the 4 videos of the workshop forever, along with templates and tools and resources. So that's why it's a little bit different. Well, and he did. It's getting there a little bit better, didn't he? I Love Discounts. I told you he only had 5 minutes this morning. He just needed some time to play with it some. So it's getting there. I Love Discounts. If you just came in, Yeah, not the hardest working, not at all. But we're just back to expand a little bit more on inventory tonight. I love discounts. Did you just hear the video conversation? Have you figured out videos yet? Has any, y'all, I'm just really curious. We're going to see if this video thing works. Because when I got asked that question this morning, it piqued my interest. So I have 2 out there. If you ever see my videos, like in your For You page, drop me a quick DM so I know. Tony saw one a long time ago. Okay, well, I just put 2 out a couple of hours ago. Let's see if they show up in the next few days for anybody. All right, let's move on with our inventory discussion, because Friday nights are usually a little bit shorter because, not a lot of people want to talk tax on a Friday night. There's a lot funner things to do, a lot more fun things to do, whatever the proper English is there. This morning we talked about inventory sitting on your shelf. So we made the point very clear that inventory sitting on your shelf is no different than cash sitting on your shelf. And that's why we don't want to leave it sitting there forever. We want to make decisions about it. We want to analyze it. We want to go through our inventory periodically to say what's moving, what's not, what do we need to do with it if it's not moving. The main thing is making that decision. So once we make that decision, we're going to talk about what some of those decisions are. What does that mean for us in accounting wise? What does that mean tax wise? So before we even get there, your dead stock, is it trippy every time I say Tony? I'm sorry. Yes, it's Tony and Lysandra for I Love Discounts. Every time we have an inventory item that doesn't sell, that is dead stock tying up our cash. So dead stock is inventory. It's something that is not generating you any revenue. We buy inventory so we can sell it to make money. The longer it sits on your shelf, it's costing you. It is not making you money. We don't want that to happen. So we're looking at ways to prevent that. Every dollar that's sitting there on your shelf is a dollar that you can't buy new inventory with. You can't hire a shipper. You can't pay a bill with. You can't fund your next, sourcing trip. So it's really important that we're paying attention. But when I click on it, it's just a picture. Really, mamas? Well, we're gonna have to look at that a little bit more. So we're gonna keep testing it out. I wonder if it clicks here, if it shows just a picture, but a video elsewhere. I don't know. I'm going to get on my other account after the show and go play with it some more and see if I can figure out how to see it. When we're thinking about our inventory sitting on the shelf, it's not just the piece itself. We're not just thinking about the money that's sitting there. We're thinking about the lost opportunity cost of that. What you could have done with that money instead. And this is kind of the next level from what we were talking about this morning. So it's not just the fact that it's sitting there. Now let's take it to the next step and think, what could we have been doing with that money that's better and more use to our business than that item sitting on the shelf? What's the next step with that? Excuse me. I want you to think, I'm at 256. Oh, wow, really? That would interest you there. And I cannot use Apple products. I do not like Apple products. I have an iPhone.
Do tell, Tony.
But I am a Windows person and my husband is a Mac person. This is like World War III in our house. Let me just tell you, when we're trying to hook up to servers and stuff like that. He's been trying to convert me for the whole time since we met. Thank you for sharing the show.
My next project that I'm thinking about is to launch a drone and get you guys with a live feed from the drone to open the show.
Okay, live from Pennsylvania.
I don't know.
He always has an idea. And he gets on me for always having crazy ideas. Listen to that. When we're thinking about our dead stock, I made an analogy. You're still doing your thing? Awesome. I made an analogy this morning. It's like putting money in a bank that you can't withdraw until somebody tells you you can withdraw it. You can also think about it that you have that money in the bank and you can't touch it and it's not earning interest and it's not doing anything. It's just sitting in the bank. To me, that sounds incredibly painful to have money that's not working for me. So we don't want that. We've already established that. I'm not going to keep drilling on that because we talked a couple hours this morning about it. What do we need to document for write-offs? We want the tax deduction. We're like, okay, I'm getting rid of this. What do I need to do? So a write-off is how you tell the IRS that this piece of inventory is not generating you income. This piece of inventory is no good for you. And the IRS, surprisingly, they don't just take your word for it. You have to have some type of proof. And we're going to talk about what proof do you need. So there's really 4 things that you need when you identify a piece of inventory that you're like, this is a bad decision, inventory's not selling, I'm getting rid of it, I'm just going to write it off. So what do we need to do? What 4 things? First thing, the original purchase price. That has to be documented somewhere. That's really easy. It's what you paid. It should already be in your inventory listing, should be in your accounting records. You already have a receipt filed away somewhere because you bought it at some point in time. So that's an easy one. We referred to that as called your cost basis. Your cost basis is what you paid. That's the technical term for it. Number 2, so you can write off, but you got to get rid of it. It's only if you get rid of it. You can write off inventory that is not selling. And you should be doing something with inventory that's not selling. We're going to talk about five options for things that don't sell. So if you decide that writing it off is what you need to do, you're going to donate it, you're going to dispose of it in some way. You need 1, that original receipt, you should have had that, right? 2, evidence of the worthlessness or the disposal, a photo of the damage, a donation receipt, a disposal note. So think about this. You don't need all of those things, but you need something to prove that you're not just holding this to sell it at a later date. You need something to prove that the worthlessness of this item. Typically, that's just a donation receipt. A lot of us, once we deem our inventory is no good at all, it's usually donated. A lot of us have donation receipts. Wait, I can't do Tony down entertainment expenses nope, sorry, no entertainment expenses. But, that piece of glass that's not selling, you can write that off. So when we think about, I also have an antique booth and had vintage rock posters with a value of a $15,000 stolen. Would the police report be considered the receipt? Yeah, the police report, that would be your, like a disposal note. That would be a receipt of what happened. Now, the value, you don't write off the value though. You can't write off $1,500. You write off what you paid for it, your cost basis. So whatever you put into it is what your write-off gets to be. Because let's think about, what do we do when we buy it? When we buy it, we take the money out of cash and we put it into inventory as an asset. So our accounting entry is we take money out of cash, we credit cash, and we debit our inventory. So, am I doing that right? Debit, yes. Credit cash, debit inventory. So what we're doing is you're recording the original amount when you bought it. So when you dispose of it, you're just pulling out the original amount, the cost basis. I want to touch on donation receipt here because this is something I hear that's a misconception very, very frequently. You'll hear, oh, it's no good, just donate it. If you made bad decisions, you got inventory you want to get rid of, just donate it. It's a write-off. Donate it. It's a write-off. They're mixing 2 concepts together. In business, for your Schedule C, for your inventory, when you donate it, you're taking it out of inventory and you can recognize the expense, the amount that you paid for it, as an expense, as a write-off. You then do not also get to take a charitable donation for it. You can't do both. That's double dipping. That's taking a benefit twice from the same item with the IRS on your tax return. So your business assets that you are donating, you're donating out of the kindness of your heart, and somebody's going to receive it and love it. You don't get to write it off on your Schedule C as an expense and then go to your Schedule A on your personal return and take it as a donation. It doesn't work that way. Now, if you have 0 cost basis, you paid nothing for the item, you have nothing to write off, now you can take the charitable donation on your personal side because you're not taking any of the money on your business side. I hope that makes sense because I hear this a lot, and the people who say it are kind of half true. They're like, donate it, get the write-off, but the way it's said often is that it's like you get to do both things, and it's not really, you don't get benefit of both things. So when you're going to dispose of something, if you're going to donate it, you need what you paid for it. To Aruba. We're not going to Aruba. You have to put what you paid for it. You need evidence of the disposal. Why are we getting rid of it? Is it do you have a donation receipt, a police report? Is it damaged? Is it shattered? Do you have like a communication where you got something in the mail and it was broken? Maybe you just bought it and you have to dispose of it because it came broken. There's always something. There's something you can point to, a reason why you're writing it off. So you need that. The beach and the sand we can sell. Y'all, I don't like the beach. If I went to Aruba, I would be like antique shopping or shopping in some stores. I am not a beach person either. Sand everywhere, I lived in Florida for 20-something years. I went to the beach a handful of times. I do not like the beach. Sand and me just do not get along. Neither, but it's making you money. So then the third thing you need, cost, disposal. The third thing you need, the date you disposed of the item. That's pretty simple, right? The date's going to be on whatever that receipt is that we were just talking about. The date of the police report, the date of the donation, the date that it arrived broken to you. So you need to be able to document the date. And finally, the method that you were using. Now here's something that I think some of you may find interesting. This is something that maybe many of you do not know. So the method of disposal means fully written off at cost. We're taking that full cost, right? I don't want this item. I pay $10 for it. I get to write off $10. Or the reduced or scrap value, scrap salvage value. What is scrap salvage value? Jewelry people, you may be interested in this. Craft people, you may be interested in this. Scrap value. Tracking is a part of your complete seller account. It is. Yes, it is. So the complete seller accounting course is going to take you from learning debits and credits all the way through creating a set of financial statements. So it is going to take you step by step by step so you understand how your books are supposed to be set up, how do you record stuff, probably in even a little more detail than you want, and then how do you use that to make financial statements and then analyze those financial statements. So it takes you from the beginning all the way to the end. And what you get is access to the 12 workshops I did on Whatnot with it. They're an hour to hour and a half each. And there's a lot of questions and answers, so you get a lot of that other extra parts in there too. Let's talk about salvage. How do I link what I bought on the receipt to the actual item that I sold? How do I link what I bought on the receipt to the actual item that you sold? Are you talking about in your accounting records? So you bought some inventory, you recorded it in your accounting records, and now you want to match up the sale to the item? I'll wait and see if that's what you're talking about. If that is, how do you match up the receipt to the actual item that I sold? I'm missing it. For some reason, it's not clicking what exactly you're asking me. So when you go and buy inventory, you go and buy something, you get your receipt. Okay, so when you go and buy something, you get a receipt. You record it in your books. You write down, hey, I spent this cash, I got this inventory. So now your inventory increases, your cash decreases, and you're identifying the item. You're either identifying it individually, you're saying, I bought a Lennox vase for $5. Or the easier way, because not all of us buy piece by piece, you say, I picked up a lot of items for $100. It had 10 pieces in it. So you identify it in some shape, some way. Then when you go to sell it, you're just recording the revenue. And then you're taking that cost of goods that you originally paid and recording that as your cost of goods. So you pull it out of inventory. So you should have a way to match that up in the sense of however you're organizing your inventory. I'm not sure what you're asking to link the item. That's what's confusing me. I don't know what you mean by link the item. So I'm going to walk through an example. Let's say I bought a box of jewelry, because that's nice and easy. I have a box of jewelry I paid $100 for. Okay? I just picked it up. I gave him $100 with my debit card, came out of my bank. In my accounting records, I'm going to record that $100 as inventory, a box of jewelry. That's how I'm going to label it. On the outside of that box, I'm going to write $100 on the outside of that box, and I'm going to sit it on my shelf. That's how I'm going to keep track of that piece of inventory. I go and do a show. I sell half of that box of inventory. Okay, I don't have to count it out piece by piece. I can just look at it and say, I've sold about half of this box. My next accounting entry then is to remove it from inventory, half the cost of that box. If I paid $100, I sold half of it. I'm going to take $50 out. I sold $50 worth of that inventory. It's going to come out of inventory, reduce my inventory, and go into my cost of goods sold. It's going to increase the expense. So if I keep 1 out of 10 items in the lot, I'm dividing by 9 or 10 for your business. If you're keeping 1 out of 10, so I love that math there. If you bought 10 items in a lot, and let's keep the math easy. If you bought 10 items and it cost you $100, that's $10 an item. If one of them is personal, the business expense is 9. So then it's 90 divided by 9. You see what I'm saying? So you don't do the 10 divided by the total. Does that make sense? I love the math though. I had to read it twice and I'm like, oh wait, now I gotta think that one through a second. You can't. Southern Charm's right too. You can also give each item an inventory number and write it on a spreadsheet. I want you to think though. Can I say that again for K-Pot's question or for the box of jewelry question? Tell me which one. Was it how I answered K-Pot or the jewelry? Jewelry. Okay. If I buy a box of jewelry for $100, I reduce my bank account by $100, I increase my inventory. That's the first entry. Inventory is an asset. It's not an expense at that time. We have 2 assets. I reduced cash, I put it into inventory. Then I do a show. I sell half of the inventory in that box. Let's take a step back. Before I even do the show, on that box, I'm going to write $100 on the outside of that box to put on my shelf so I know when I'm looking at my inventory that value of that box was originally $100. That was my cost basis. Okay? I do a show. I sell half of that inventory, half of that box. My next accounting entry at that point is to reduce my inventory. I'm reducing the asset because I sold half of my asset, right? Sold half of the jewelry. And I'm going to now take the expense, increase my cost of goods sold. It's not inventory anymore because I don't own it. Now it is the cost of what I sold. And because I sold half a box, I paid $100 for it. That means it's $50 comes out of inventory and into my cost of goods sold. So that's a way to track it without having to do piece by piece by piece. I like Southern Charm's idea of a spreadsheet, but I want you guys to think big. I want you to think of where you want to go. When you have 50 items, it's easy to list 50 items on a spreadsheet and keep track of 50 items. And you have these 50 items, you have it listed out. I have a vase, I have a flower pot, I have a piece of glass, and it lists out your cost. But what happens, I understand. Thank you, honey. You're making, he's talking to me while I'm in the middle of a thought. I understand. I have an example I'm going through. And I've just lost my train of thought. You do this to me every single show. When you list it in piece by piece on a spreadsheet, if you have 50 items and then you sell one of them, it's really easy to go back and sort through 50 items and put the exact cost you sold it for. What happens if you have 1,000 items, 1,500 items, 2,000 items? What happens when you get bigger and bigger and bigger and you're buying huge quantities? You're going to spend all of your time trying to list out item by item by item, and that becomes inefficient for a 1 or 2 person show. For a 1 or 2 person operation, you can't, there's no way. All you're going to do is spend time creating spreadsheets. You're never going to be able to source, to sell, to ship, to make social media and do all the other stuff. Now, if you're a large corporation, there's computer programs, inventory systems, and things that you buy where you have scanners and it does this all automatically. They are doing it piece by piece by piece because they've invested a lot of money into equipment and computer systems that do that. So we are in this spot as resellers, many of us are, where we're either really small and we can do it that way, piece by piece by piece on a spreadsheet, or we're kind of in this middle spot. We're like, no, it's going to take too much time, but we're not big enough. We're not a corporation that has an accounting department with an inventory department and all the fancy stuff. So what you need to think about when you're setting up your inventory system is, okay, this may work when I have 30 or 40 items. What about when I get the 100 and the 1,000? How much time is it taking me to record in that manner? So am I talking about accrual? I only recommend accrual accounting. I really don't do cash basis accounting. Cash basis accounting is not proper GAAP. It's not generally accepted accounting principles. Cash basis accounting is on the fly, fast and go. It's not generally accepted accounting principles. So when we're talking taxes and inventory, you have the choice to record your inventory as accrual or cash. There are very, very, very few really good reasons why you would record it as cash. Very few. What happens is it usually comes back to bite you in the butt. That's why we don't record as cash on our tax return typically. If you're not sure the difference in that for taxes, I'm more than happy to explain it a little bit more. Accrual is always best. Michelle's saying it to you. Accrual is always, that is the proper way. Accrual accounting, let's just high level, we'll talk. Okay, accrual accounting. Accrual means you are matching up the revenue and the cost to produce that revenue together. Okay, we are keeping, if I make $100, what does it cost me to make that $100? So think of it in that high level. That's pretty important, right? Because I can make $100. If I don't know the cost it takes me to make that 100, it's kind of irrelevant. I don't know how to repeat it, how to manage the expenses or anything. So accrual accounting is matching up your revenue and your expense within the same time period together. When it comes to inventory, what that means is when I buy inventory, it's an asset. It's something I own. It's not an expense, okay? When I go and buy stuff, it's a cash outflow. That is it. It's a cash flow movement of money. There's no expense associated in buying inventory. I still own something. Then when I sell that inventory, the cost I paid for it becomes an expense to me. What does that do? It matches up because I sold it, the revenue that I earned to the expense of that product together. You take the revenue, thank you very much. You take the revenue, you minus that cost of goods sold, that expense, and you get your gross profit. Now I have some real meat to work with. Now I know that if I sold a $100 item and it cost me $10, my cost of goods was $10, and I have a gross profit of $90, that I have a 90% gross profit, right? Now I have something to work with. That's accrual accounting. That's proper, generally accepted accounting principles. Any public company, any set of audited financial statements are going to be done on accrual accounting. Cash accounting. When you get to your tax return, they allow you to say, hey, for my inventory, I can do cash or accrual. I can do what I just explained, or I can take everything I bought this year, all that inventory that I spent money on throughout all of 2026, every single dime, and expense it all off as cost of goods sold. Let's walk through a year or two of this. Let's see how that looks. You go into business this year in 2026. You spend $10,000 on inventory. Okay? It's sitting up there as inventory. Comes time to do your tax return. Maybe you sold, let's just keep this clean. I got to write this down to keep it in check. I spent $10,000 on inventory. During the year, maybe I sold $4,000 of it. Okay? So I still have $6,000 sitting on my shelves. Okay? I only sold $4,000 of that $10,000 that I bought. But on my tax return, I'm going to say, oh, I want to do cash. So the IRS then allows you to take the full $10,000 and write it off as an expense. You only sold $4,000 of that, okay? Let's say you made, you sold $4,000 was your cost. Let's just say you made $8,000. You have a $4,000 profit, okay? You made $4,000 in revenue. Minus that full 10K, it looks like you took a loss. You're taking a loss on inventory that you haven't sold yet. So now we come to the next year. We go to 2027. I still have a big chunk of that inventory sitting there. I sell it. I get revenue for it. Now I have zero expense to apply to that revenue that I just earned in year 2. What does that mean? I'm paying more taxes in year 2. Because if I took in year 1 all the money that I paid for my inventory and wrote it off, I'm more than likely probably going to really drive down my taxable income. That looks great in year 1. Year 1, I'm like, yeah, cool, I'm not paying much taxes. Year 2, now I'm selling the stuff that I already took the expense last year for, and I have to claim 100% of that revenue because I have nothing to write off against it. This is why I say there's very few instances that cash on your tax return for inventory is beneficial. It's outright. And then what starts to happen is you're in this never-ending cycle of trying to buy more and more and more to offset the costs that you have. It becomes a cycle. The times that it makes sense to do cash, maybe you're going to be closing down the business. Maybe you're in the last year of your business. Then it would make sense. Maybe you're downsizing your business. Cash may make sense. There are times it's an appropriate choice. That's why the IRS allows it. This is where you get a CPA or a tax advisor of some sort to help walk you through the various scenarios. The problem is people get on Whatnot, their CPA tells them something and then they come and repeat it here. The problem with that is their CPA is telling them based on their facts and circumstances, not yours. But they assume that we're all the same, and people will get on Whatnot and give you all this advice, and it's not true because it doesn't fit your situation. So it's really good just to understand what the rules are and then go talk to your professional with your facts and circumstances, and they will help you figure out what's best for you. But just having a basic understanding of it is good. I hear all the time on here, oh, you can just write it all off. You can write off all your inventory. Good luck for you, because I can guarantee you it's biting you in the butt in year 2 or 3. Yes, always understand the basic principles. So that's cash and accrual. I hope that makes sense. That's cash and accrual around inventory. When we think accrual and proper accounting, I'll give you another example just to kind of make it make sense here. So when we're looking at matching up proper expense to the revenue that it generated, think about your electric bill. I want you to think about using your electricity in the month of December. You go all month long, you're heating your house, you're using electricity, the lights are on, okay? Do you usually get that bill December 31st? Do you usually pay for the electric you used in the month of December? Is it usually paid by the end of the year on December 31st? Typically, no. Typically, you get the bill January 5th, 10th, something like that, right? For the prior month. You usually get a utility bill for the prior month. In accrual accounting, what we would be doing to do proper accrual accounting is when we sit down to close our books on December 31st, we would estimate the cost of that bill, and we would actually put it into our books as of December 31st, even when we didn't receive it. We're accruing the cost, therefore accrual accounting. We're matching up the expense to the proper time period and the proper period that we produced revenue. So everything matches up nice and neat so that when I look at my books for December, I'm saying here is all of my expenses, whether I wrote the check or not, all the expenses that I accrued during this month that matches up to this inventory that I earned during this month. Therefore, I get very clean accounting records. That's accrual accounting. When you're doing your books, you're probably not doing that, and that's okay. You're not having audited financial statements. You're not, submitting, you're not a public company and having these a part of an IPO or submitting them through the SEC. So it's okay. However, if you were to get to the point where you have organized as an LLC or a corporation or elected an S election and you want to get a bank loan, and the bank says, I would love to give you a loan, but I need to see an audited set of financial records. That means all the records you do, you'll have to hire a CPA, and they will then make them all accrual financial statements. So if you're currently doing cash, what is the best way to switch? If you're a small business, and we're kind of mixing two things here, so I want to take a step back and make sure it's clear in two different ways. For your accounting, put tax aside. We're not talking tax. For your day-to-day accounting, you can do cash and be okay for a small business. You will not need to do accrual accounting for your business until you get to a point where you need audited financial statements or you need to produce some type of financial statements for a loan of some sort. or maybe you're getting a building, something like that. You can do cash for your day-to-day accounting. You'll be fine. It's not going to make a huge difference for you. When it comes to your tax return is done on an accrual basis for your inventory. Okay? You don't have to worry about all the rest of the stuff. Your tax return is based upon when you actually paid it. Accrual, what I just described, it accrual for accounting doesn't apply to tax for your general expenses. For inventory, it does. So you don't really have to worry about switching. What you do when you file your tax return is you only take the expense for the items you sold. Inventory is inventory. The items you sold are cost of goods. That's your expense. Does that make sense? So it gets confusing because accrual and cash is really an accounting concept, but then the IRS will use them for certain types of expenses. So the language gets a little mixed up. So I really am trying to make sure that we're talking accounting or we're talking tax. And for tonight, we're really kind of focused on the inventory side of tax. So for inventory, you really want to do on your tax return, select that accrual method and only expense what you actually sold. It's going to save you a ton of headache. It's going to save you money in the long run, unless there's certain circumstances where then your tax advisor would say, nah, we need to do it this way. It's better to do it under cash. All right. I want to talk about another concept here. So buy it, it's inventory, sell it. Yeah, there you go. That's it. That's it right there. Mama's way. I wish I could stay. Oh, well, have a good night at work, Michelle. Thank you for stopping by. I want to talk about salvage value. This may be of interest. The category that came to my mind for salvage value as a good example is jewelry. And I know we have some jewelry sellers in here. If you have a box of jewelry, I can almost guarantee you as a jewelry seller, you have a box of jewelry that you bought. It was part of your inventory. But as you're sifting through it, it's a broken chain, earrings missing backs, something's wrong with it, stones are missing. And you probably have a box of stuff that you describe as a craft lot. Probably. It's probably a term you're going to use. A box of broken jewelry of some sort, mismatched jewelry, whatever it is. The basic concept is jewelry that you cannot just pick up a necklace and sell it. It is not just, oh, here's a great piece of inventory I have, I'm selling it. You have this box. Well, you can't really, it doesn't have that same full value, right? So if you add all these pieces together, maybe all of it, the cost-wise, let's just say it was $100, but you're like, I can't really just sell it as inventory. Like I can't pull out a broken necklace and sell it. It's salvage, it's scrap, right? That still holds value because you could take a whole scrap lot and sell it as a crafting lot of some sort, or you can melt it down. You can do something with it. Typically, we're assuming that there's some value there. You want to just throw it in the garbage, right? You want to just donate. You can make a little bit. This is where you make a decision. You're like, I'm going to take this at salvage cost. So if you paid $100 for all of this all together that ends up being scrap, and you're like, you know what, I can still get 20 bucks out of it. You could take the $80 and write that off and still keep part of it, keep the $20 on your books because you know that you could give it to a crafter or give it to somebody else for that 20 bucks. Is it still full, usable, good inventory? No. That's why you're going to immediately be able to take a piece of it off and write it off. That's salvage. That's very different than me as a vintage seller picking up something and saying, you know, I can pick up this creamer and say, man, this was a sucky purchase. Nobody's ever going to buy this. You know, I'm going to donate it. And I donate it and I just write off the full cost. There's no value left in there. Okay? So I want you to think about that when you're a jewelry seller, that you can take some immediate write-offs on all that scrap stuff, the missing stones, the broken pieces that you intend to make a little bit of money on, but you can't really get that full inventory value out of it. So there's that concept of salvage that allows you that immediate write-off. And a lot of people don't know that. So that's even if you haven't sold it yet and you go to do your tax return and you're like, oh, but Tracy says I can't take the expense if I haven't sold it. If it's salvage, you can take partial of that expense right up front on your tax return as at salvage cost. So the general rule out of all of this, if you can't show, basically saying damage, except that you've got to think about it a little slightly different. Damage, it's salvage if there is still some value left. If it's damaged, if I had this creamer and the handle broke off, I dropped it, broke the handle off, that's not salvage. There's no piece of that I can still sell and have any value out of. But if I have jewelry that has a few missing stones, it's not full value, but there's still some value in it. I can still sell it. So if this is in two pieces, this is damage, 100% write-off. If it's jewelry with stones missing or chains that are broken that can be melted down, that's salvage because there's still some value in it. Here's another example. Maybe you have a B box. Let's do a vintage example of salvage. Maybe you have a B box and you're so proud of this B box and you're gonna make it big on your next show, and you're washing it and you drop the lid and shatter the lid into a million pieces, and now you just have the bottom of a B box. That really sucks. But the bottom of the B box still has value. You can still sell that bottom of the B box. Are you going to get the full value now that you don't have a lid? No. So now instead of a damaged item that I'm going to write off 100%, I have a salvage item. I'm going to write off a little bit because I broke the lid, but I can still sell the bottom of the B box. So there's a vintage kind of example for you on how the same concept would apply. Okay, let's keep going. Documentation, I want you to think about those four things we said. Your cost, you need your cost. We need evidence of the disposal of some sort, the date you disposed of it, and is it fully written off for salvage? So how much of $1 worth of the box do you write off as salvage? I would probably do like 50%. I mean, if I had a top and a bottom of two pieces, for me, I would say 50%. There is no hard and fast rule. You have to estimate. You have to be conservative in your estimate. Be conservative and as truthful as you can in identifying. Document how you came up with it. I would say it was a two-piece set. I broke one piece. I can still salvage the other half. I'm going to take 50% as my write-off. So there's your documentation. How much did you pay for it? Your evidence of your disposal. You know, your receipt, a little note you write yourself, something explaining what's happening with this thing. The police report, as somebody pointed out earlier, the date that you're doing this, and then is it fully written off or is it a salvage? Those are the four things you need to keep. Without that, the IRS doesn't accept it. You could put it on your tax return, but if you're audited, they won't accept it. So those are the things you need to keep in your records with your tax returns for just as a standard course of practice. Think of it like a store receipt. When you go to the store and you don't have a receipt, a lot of times they don't, they kind of ask for that receipt. They may accept it, but the IRS is the same way. You have to have that documentation to get it to go through. Very interesting fact from the IRS is that when we're looking at, and you can go to the IRS website, you can dig through it. There are a lot of statistics that the IRS puts out where it talks about common reasons for being audited, what are the red flags, like all of this stuff is public information out there. So one of the things, the red flags with audits are high disposals, and we call this like obsolete, damaged inventory, high cost of obsolete or damaged inventory without the original cost basis documentation. So because let's think from the IRS eyes, this is a way to write off expenses. It's an easy way for scammers to get through the IRS. How easy would it be for you to say, oh, guess what? I got a lot of damaged inventory. I'm going to take a lot of expenses on my tax return, even if that's not true. Very easy for scammers. So this is one of those areas that your documentation becomes even more important because it's one of the areas that the IRS is looking at. Not just the fact that you may have it. They really don't care if you write stuff off like that. What they care about is if it's excessively high. That could be a red flag. Now, it could be excessively high and be completely truthful if you have the proper documentation to support it. Just understand, it's one of those things that the computers are programmed to pick up on that if there's a ratio of a lot of damaged items, the IRS is going to be like, what's this reseller doing over there? Are they breaking all their stuff? Like, why would they have so much damaged items? So there are a few things like that with the IRS, that there's certain areas that they'll pick up on quicker just because it doesn't make sense. A lot of the stuff that we get afraid of with the IRS, we prevent just by having documentation and kind of thinking through, well, does this make sense? So I want to talk about moving to the next step here on decisions. Your decisions with your inventory should be intentional. This morning I talked about every so often, periodically, whatever works in your business, 30 days, 60 days, 90 days. How is salvage different than I just bought a B box for 60 and sold it for 30? Because you sold it and you got revenue, you sold the whole thing. You sold the whole thing there. So if you bought a B box for 60 and you sold it for 30, you just took a loss on that because you made a bad sale. You had every potential of selling it for more than the 60. But if it's broken, you've lost that potential. So if it's a good, solid piece of inventory, that potential is there to sell it at an arm's length transaction for a fair price. Now, if you continue to make bad buys, if that's just you're paying too much for your inventory and you're selling everything at a loss, that's bad business. So the difference is that the potential is gone because it was damaged or broken. I need to tie this back to a larger concept. This is where it gets a little, not iffy, but we have to understand the way the IRS rules were written. They weren't written for small businesses like us. The IRS didn't write things for us. They wrote it for large corporations, for big companies. When you think about a big company and you think about the salvage stuff, first of all, they're probably not buying stuff for 60 and selling it for 30 a lot. The concepts, the way that the rules were written were different. So we get into these areas like what Liz is pointing out where it seems a little like, that doesn't make a total sense for me. It's because the rules weren't written for us. The concept of salvage and obsolete inventory, think of a manufacturing plant. So when we think of a manufacturing plant and you have all this equipment in there and it sits and gets dusty, a lot of it could be scrapped. A lot of it is not just throw it in the garbage stuff. It could be melted down. There's a lot of metals. There's a lot of things that could be turned into another use. So while they can't sell it or while they can't use it to build something else, there's another use for it. So when we think about these rules the IRS has, a lot of it was written for companies a lot bigger. The same goes to the entertainment tax rule that we talked about earlier. We can't write off entertainment tickets anymore because what would happen is a lot of the insurance companies and the travel agents and these bigger companies would use entertainment to take all of their buddies to the suite at the football game or to the strip club or whatever else and write it off. They then ruined a basic entertainment for the small business guy. So you got to step back and look at it that we kind of reap and we're kind of dealing with rules that really weren't written for companies of our size. In most recent years, last 10 to 15 years, the IRS has introduced a lot of measures into their regulations to help small businesses. The simplified home office deduction was geared at small businesses. The simplified using mileage instead of actual cost for your vehicles was written in for small businesses. So as we progress, the IRS is identifying these areas that are more applicable and written for big companies and trying to amend it or put extra ways in, simplified versions for us smaller people. They're just not there yet. It's just like anything else, it takes time to catch up. So we talked about that. Decisions should be intentional. So one of the things we talked about, periodically, you should be going through your inventory and looking at your inventory and saying, that sat there longer than I wanted to sit there. What am I going to do with it? What am I going to do with this piece of inventory that has sat for longer than 2 months, 3 months, whatever the time frame is that you deem is an appropriate time to sell an item? So we go through and do that. And then we have to make a decision. And they should be an intentional decision. I'm going to give you 5 common things you can do with a piece of dead inventory. Something dead stock, it's never going to fix itself. Dead stock sitting on a shelf is dead stock sitting on a shelf. It's your cash sitting there until you decide to do something different with that item. So what can we decide to do? Here's 5 things. Number 6 is what not to do. So number 1, mark it down and sell it. Get out of it whatever you can. That's one option. Okay? There's no tax implications. It's just like a normal sale in that case. Mark it down, sell it. Bundle it. Put it with something else. Try to use another value item to increase it. Try to get your money out of it. Again, normal tax. There's nothing special you have to do with taxes there. It's just a normal accounting record. You can donate it. You can say, this isn't worth selling. Nobody's ever going to buy this. I'm going to donate it. We've already talked about then. We can take the cost off on our tax return. We can dispose of it, which means throw it away. Maybe it's broken. Maybe it has a huge crack. You're like, this has a huge crack in it. I'm not even going to give it to Goodwill and burden somebody else with it. I'm just causing Goodwill work on something that's not good anyways. I'm going to throw it in the garbage. We then dispose of it. We take that full cost as our tax deduction. We can hold it. That's number 5. We have the choice to continue to hold that inventory. But if you're going to hold it, make the decision intentionally and hold it with a plan. Don't just hold it to hold it. If you decide that you can't sell it, you don't want to throw it away, you don't want to donate it, you're going to hold it, put a time frame on it. Hold it with a plan. I'm going to hold it for this show, and if it doesn't sell in this show, then I'm going to do X. I'm going to hold it and list it on eBay for 4 months. And if it doesn't sell, then I'm going to do X. Hold it with a plan and a date to make another decision on it. That's your 5 choices. That's really all the 5 choices when you're looking at your inventory that you have to make. Now let's think about this in practicality. If you have a few thousand pieces of inventory, you're not going to go piece by piece and pick up each piece and say, okay, what am I doing with this? What am I doing? You're not going to do that, right? Usually your inventory is grouped by, hey, I got all this inventory for this show. We're going to sell it. You're going to go look through and you're going to be like, I've had that inventory quite a while. Maybe you rotate your inventory in a certain way. So you know how old it is. Maybe you use certain color stickers to identify the month you bought it in. There's various ways that you can keep track, whatever works for you and the way your mind works, to know how old something is. So you're going to zero in on, hey, I really want to look at inventory that I've had for more than 60 days. It shouldn't be sitting on my shelf for longer than 60 days. Now, don't take 60 as a hard and fast rule. I'm throwing that number out there. You need to decide what that number is for your business. For me, it's about 4 to 5 weeks. I don't want anything sitting on my shelves more than 4 to 5 weeks. You're going to take that inventory and then you're going to make one of these 5 decisions. Mark it down, sell it, bundle it, donate it, dispose it, or you're going to hold it with a plan. That's your 5 choices. Number 6 is the one I never recommend. Number 6 is a choice, but not a good one. Number 6, the worst option you have, and this is the one that most of us default to because it's paralysis by analysis, we don't want to make decisions, is we hold it indefinitely without a plan. It's not selling now. It'll sell someday. And it goes back to what I was talking about this morning. We justify letting things sit on our shelves because of stupid emotional reasons. I know I can it became a family member. Yep, it's part of you now. It's part of you. It's as Mama's put it, it's them leftovers you shoved in the back of the fridge that you swear you're going to eat. You'll look at the inventory and you will not make a plan because you'll say, I know I paid $30 and I can get 60 out of it someday. I know I can. I saw these sell on eBay. Butter pats are coming back around. You will make every excuse in the book to keep that inventory sitting on your shelf without a plan. That is the worst decision you can ever make. That is cash tied up that you cannot use sitting on your shelf. Worst decision. Go with the top 5. Mark it down, bundle it, donate it, dispose it, or hold with a plan. Figure out what you're going to do with it. So make decisions intentionally on that old inventory. If you leave it sitting on your shelf, let's think about this. Let's think of the tax implication of this. If I just choose to not do anything and let it become a family member on that shelf, I can never write it off. My cash is sitting there. I don't even get the benefit of that tax deduction for it. It's just money on my shelf. Make the plan for it. At least even donating it, you could take the cost on your tax return. You're reducing your taxable income a little bit. I'm not saying to donate for a tax deduction, but sitting on your shelf is doing zero for you. So in the worst case scenario, if you can't sell it and recoup some money, at least get your tax deduction for it, at least. So at least there's something coming out of this experience besides the family member on the shelf. So I want to keep going here. I want you to think also about when you're making these decisions, when you're thinking through the inventory, your inventory is like a report card. It's giving you information. It's telling you data. If you look at, I'm going to use pottery. If you sell pottery, I can't get pottery to work in bulk, in like large pottery shows on whatnot for some reason. I just can't. I love pottery, but it has to be hit or miss. It has to be the right pieces. But if you're looking and you say, you know what, every time I price pottery over $30, it doesn't sell. It's been sitting here. I have all this pottery that's priced over $30. It's been sitting here for 60 days, but all the pottery that I priced under 30 sells like that. When you're making those decisions, in your head, you should be thinking like those pattern recognitions. You should be thinking through like, wait a minute, how come this pottery is still sitting here, but the other pottery I had sold? Well, because this is all priced higher. Why is this one here? Looking at your inventory on a periodic basis gives you the chance to evaluate your purchasing habits. What's selling, what's not selling. That's not just a 5-minute practice after a show. Reviewing your inventory that's still sitting there keeps that fresh in your mind and helps with those decisions moving forward. You may realize that, you know, the 4 pieces of pottery that you have sitting there that are over $30 that haven't sold, when everything less than 30 is selling, you'll go back to your 5 decisions. That may make it really nice and easy to say, you know what? Let's just drop the price on this one instead of donating it and see if I can sell it in the next 30 days. So looking at what's happening then leads you into which of these 5 decisions should you be making. It's just kind of like a flow chart where it's, did it do this? Yep, do this. Did it do this? Nope, do that. Makes it super simple so that you don't have to get stuck in that paralysis stage. That's exactly it. People don't want to admit that they can't source productively or that they made a bad choice. It's okay. It's okay. I'm going to go back to your inventory is like a report card. So every piece of your inventory is a grade for you. The A's, you get an A, shows you what's working. It's selling. You put in a show, it's gone. That's an A. A plus for you. You made a great decision. The F's, the ones still sitting on your shelf 3 months, 4, 5, 6 months from now, those aren't failures. That's feedback. That's, don't do that again. I learned. Okay. I'm going to buy an A item next time, not an F item. It's not failure, it's feedback. I'm learning from this. I'm learning that I need to drop the price. I'm learning that I'm pricing too high. I'm learning that people don't want to pay shipping for the big items. Whatever it is, whatever that pattern is that you're seeing, those patterns will emerge. You start watching your inventory, you start reviewing it, you take time after the show, and all of these, you see, it's all kind of coming together. I'm talking about inventory and accounting and tax write-offs, but in the process of reviewing that, I'm also now learning, recognizing patterns on what I can source. None of these parts of your business exist as a standalone. They all relate to each other. The more you master one, the better you get at another. And you keep improving. We tend to look at people and think, oh, they're just so lucky. They've just done so great. And, you know, the inventory gods are smiling on them. No, it's because most of these people are taking time to review what sells, what doesn't sell, what is the right price point, how long do I have to hold it? If I keep it on my shelf, I'm tying up my cash, but if I keep it moving, I get cash to buy more. It all relates into each other. So that pattern recognition is key. And it's not something that you have to say, oh, I don't do pattern recognition. I'm not really skilled at that. It's not even a skill. It's your business. Who knows your business the best? Who is more intimately involved in your business than anybody else? That's right. You are. You know this stuff. You just need to give yourself credit for it and take a moment to actually practice, to not even practice that skill, to sit there and say, let me just think about it. No, I meant, no, I don't know your business. You know your business the best. So, final point on this is liquidity. We talked about liquidity this morning. That is your cash available. That's how much money you have in the bank to keep things moving. Okay. Everything we talked about here kind of comes back to keeping that money liquid. Looking at your inventory, understanding the tax implications, making those appropriate decisions. So this isn't like, oh, I need to do this once a year. I need to worry about my inventory at tax time. No, you should be doing something monthly. And I'm going to tell you, I have a checklist here of, this is like a simple 3-part method that you can implement, take you maybe 20 minutes a month, and can save you thousands of dollars throughout the year in money sitting on a shelf or lost tax deductions. So monthly, set aside some time every single month to review that inventory. Figure out what is your turnover rate. How fast do you want inventory to turn over? What is the longest amount that inventory can sit on your shelf that you are okay with? And I don't want you to say inventory. What is the longest amount of time that you would take a couple $1,000 and sit it on your shelf without touching it that you're okay with? I said it this morning. Is this in my PDF? These notes, yeah, the notes here are in the library one. They're in here. So all of my Friday shows, I put all the typed up notes in this library. So they all go into a Dropbox along with a bunch of other PDFs and Excel files. And then two sets of notes every Friday you will also get from the topics I talk about on that Friday. So monthly. So every month, take 20 minutes. Figure out, first of all, how long are you comfortable having a few $1,000s sitting on your shelf? Don't picture it as inventory. Picture it as actual cash sitting on your shelf. How long are you comfortable with it sitting there? And that answer is going to look very different for each one of us in this room. I've already said mine is 4 to 5 weeks. After that, I'm making decisions. Maybe this type of stuff you sell is more high-end, sells a little bit slower. It's going to sit there a little bit longer. Maybe it's health and beauty that has expiration dates, has to move a little bit quicker. So it's going to look very different. So you, understanding your business, have to figure out what is the appropriate time frame that I'm okay allowing my cash to sit on the shelf without it moving. Once you know that, take 20 minutes at the end of the month and identify the items that are coming up to that deadline. What items are hitting your 5-week, 30-day, 6-month deadline, whatever it is. Identify them. It shouldn't take very long. If you have an organized system, it shouldn't take very long. It's going to be drastically difficult if you're shoving stuff in tubs and putting them all far off in the corner and ignoring it. That's not proper inventory management. So take the 20 minutes, identify it, then make a decision. Go back to those 5 decisions. All right, I found these 4 pieces. These 4 pieces have been sitting here too long. What am I going to do with them? They're going in the next show. I'm donating. I'm disposing. What am I doing with them? Make your decision. And then document it. Write it off, put it in your accounting records, document it. That's it. 20 minutes a month can clean up your inventory, help keep it organized, help keep that cash flow moving so you're not just tying up cash. It's a small little habit that reaps big rewards. I want you to think about it like this. How many minutes a day do you spend brushing your teeth? 5? 5 minutes a day brushing your teeth? 5 minutes a day brushing your teeth prevents how many thousands of dollars in savings in dental work? Pain, discomfort, right? That 5-minute habit you have every day, you do without even thinking about it. You do it automatically because it's good for you. It's good for your health. It's good for your teeth. Keeps your teeth in your mouth. Keeps you from being pain-free. Allows you to eat. You reap all these rewards from a small 5-minute habit. This same mentality works in your business. A 20-minute habit once a month can save you thousands of dollars in money, keeps your cash flow going in your business, saves you on your taxes. So it's doable. People think, oh, I just don't have this time. It's only me, and I have all this stuff to do, and I can't do this once a month. That's another 20 minutes. I don't have time for accounting. You do if you think about the implications. You do if you think about, what it's saving you in the long run. You make the time for it, just like you make the time to brush your teeth. And I know those two things are completely not related, but the concept's the same. You do it whether you want to do it or not because it's good for you, right? So that's it. That's all you got to do. 3-step process once a month, and it's really simple. I had a little quote here. It says, "Dead stock isn't a mistake you're stuck with. We may have made a bad decision in the past. That's okay. It's a decision you haven't made yet. Make the correct decision. Document it and get that money back to work for you. Don't let your money sit on the shelf. So that is all I have for you. I went through all my notes tonight. Do you guys have any questions? Anything else going on that you want to talk about before we go find somebody to raid? I'm happy to answer questions, or we can go raid. So I know it's Friday night. Taxes, accounting, a heavy Friday night topic. I do have actual plans, though, coming up in 2027. I'm not going to be doing the Friday night tax talks. I'm trying to transition more so to more mornings, only do one evening show in 2027, but I'll be finishing out the rest of this year with the way I have it planned. Does today's no commission help improve your average order value? No, your average order value is computed before any fees are deducted. So it improves your bottom line, improves the net because they're not taking out that 8%. But your average order value is based on your total sale divided by your total items. So it's still how good you can get it. Now you do know it's just the 8%, not the 2.9. So they're still charging the 2.9%. But heck, I'll take 8%. I'll take a little bit of savings. I'm happy with that. Every little bit helps. Really quick plug, Reselling Roundtable on Sunday night. I love discounts. Green 13 and myself, we come together, we do Reselling Roundtable on YouTube. It is a podcast at 6:30 Eastern Time. This week we are talking about, what's our topic? Is it a myth, or what's the dollar starts and free shipping? The myth of dollar starts and free shipping? I think that's what we're talking about. I don't know if that's the full title. We're talking dollar starts and free shipping, or low starts. So that's our topic for Sunday night. I encourage all of you guys to join in. It is a live podcast, so you could ask questions. And if not, we are on Apple and Spotify, Apple Podcasts and Spotify if you miss Sunday nights. And with that, you guys, we're going to raid. Don't miss my show tomorrow. Y'all go bookmark my show tomorrow morning. Come see me. We're doing Elegant and Timeless. I got some gorgeous stuff. Gorgeous, gorgeous stuff tomorrow. Can't wait to sell it. We'll be here at 8 a.m. And with that, we're going to go find somebody to raid.
Already got someone. You're going to like this. He's been working really hard. So
hold on.
He's kind of quiet, but I enjoy it. I enjoy it very much.
Is Spotify the same name? Is it Reselling Roundtable on
yes,
Spotify?
Yes, Spotify is the same name. If you go to the Whatnot on the profile for Whatnot, it's in there. You can check it out. All the handles are in the Whatnot profile.
We have a Whatnot name, Reselling Roundtable, on Whatnot also. So we don't sell out of it or anything. We just use it for communication purposes. All right, let's go raid, you guys. Have a good weekend. I hope you guys have some great sourcing and some good sales this weekend.
Have a good evening.